Greed is the silent account killer that sneaks up on every trader, no matter how smart they think they are. And the crazy part? Most people don't even realize they're making these same greedy mistakes every single day. If you don't fix them now, your account won't survive long. In today's video, I'm breaking down the 10 greedy mistakes that quietly destroy trading accounts, the same habits that flip small losses into blown accounts. These are real traps, real behaviors, and real reasons. Greed is the silent account killer that sneaks up on every trader, no matter how smart they think they are. And the crazy part? Most people don't even realize they're making these same greedy mistakes every single day. If you don't fix them now, your account won't survive long. In today's video, I'm breaking down the 10 greedy mistakes that quietly destroy trading accounts, the same habits that flip small losses into blown accounts. These are real traps, real behaviors, and real reasons why traders keep losing money without even noticing what they're doing wrong. By the end of this video, you'll know exactly which greedy habits you must delete, how to avoid them, and what smart traders do differently to stay alive in the market. Stay with me, because mistake number 7 and number 10 are the ones almost every trader is still doing. Greed is one of those things every trader thinks they can control until it hits them right in the face. And the wild part is, greed doesn't show up loud and obvious, it shows up quietly. It starts with a small win, a little confidence boost, and then your brain whispers, "Yo, you can double this. Why stop now?" That tiny voice is the fastest way to blow an account, and most people don't even realize how fast it snowballs. See, when greed kicks in, your whole trading mindset shifts without you noticing. You're no longer trading the chart, you're trading the feeling of wanting more. And the second you start trading your feelings instead of the plan, you're basically handing your account over to the market like, "Here, take it, I won't fight back." Beginners fall for this because they're hungry for fast results. Intermediate traders fall for it because they think they finally figured out the market. And even expert traders who've been around for years still get trapped when they let their guard down because greed doesn't care about your experience level. What makes greed so dangerous is how it messes with your risk perception. You start thinking you're untouchable after a green streak, so you size up too fast. You skip your stop loss. You hold losers because it's gotta come back. And before you even realize what you're doing, you've taken a normal trading day and turned it into the worst decision of the week. Greed blinds you to the actual market conditions. It makes you chase moves that aren't even worth chasing. And it makes you ignore every lesson you ever learned about discipline, patience, and controlled risk. And here's the truth nobody likes to admit. The market is designed to punish greedy traders instantly. You can be right 9 times out of 10, but that one greedy moment, just one, can wipe out all the profits you made in the last month. That's why greed is the fastest account killer. Not because it's dramatic, but because it happens so quietly. You don't notice it until your account balance looks like it went on a roller coaster without a seatbelt. Now, before we break down the specific mistakes, you need to understand this one big point. Greed doesn't destroy your account by itself. It destroys your decisions, one after another, until your account has no chance of surviving. And the first way it sneaks in is through the most common trap traders fall into, especially after a small winning streak. So let's talk about that next, because it's exactly where most traders lose control without even noticing. Over-leveraging is hands down one of the most common ways traders destroy their accounts. And the sad part is, most people don't even realize they're doing it until it's way too late. It usually starts with a little confidence, maybe a clean win, maybe 2. You catch a nice move, and suddenly you feel like you've unlocked the matrix. That voice in your head goes, "Bro, if you made this much with a normal position, imagine what you could make if you just go a little heavier." And that's the exact moment greed wraps its arm around your shoulder like a fake friend and whispers you into trouble. See, over-leveraging isn't just about taking a big position. It's about taking a position that's too big for your skill, your account size, and your emotional control. Beginners fall for it because they want fast money. Intermediate traders fall for it because they think experience protects them. And even experts fall for it because they start trusting their feel more than their math. But the truth is simple. The market doesn't care how good you think you are. If your position is oversized, one bad candle can flip your whole account upside down before you even blink. What makes over-leveraging so dangerous is how sneaky it feels. It doesn't feel like a mistake in the moment. It feels like an opportunity. You tell yourself it's a strong setup, you convince yourself you deserve to size up, and you promise you'll manage it if it goes wrong. But the second the market moves against you, just one tiny move, you're no longer thinking logically. Your heart rate jumps, your hands get sweaty, and your brain goes into survival mode. You're not analyzing price action anymore. You're watching your P&L bleed out like a leaking bucket, hoping the market shows mercy. And let's be real, most traders don't know how to manage a big position emotionally. When the risk is small, you can think clearly. You follow your plan, you take the stop, you move on. But when you're oversized, even a tiny pullback feels like the end of the world. You start moving stops just a little lower. You hold losers just a little longer. You swear you'll close it when it comes back. And that's exactly when things blow up. Because the market doesn't have to move far to destroy an account that's over-leveraged. One wrong candle is all it takes. The crazy thing is, over-leveraging also tricks you on the winning side. When you catch a big win with a huge position, it feels insane. Your brain gets this dopamine hit like you just found a cheat code. But that big win becomes a curse. Why? Because now you start chasing that same high. You start thinking, if that worked once, it'll work again. And that's the trap. That's where people level up their risk right into a blow-up. The market knows exactly how to punish that kind of thinking. It'll give you a taste of success, then snap the rug right from under you when you get too confident. For intermediate and expert traders, the problem is slightly different. They know leverage, they understand risk, but the moment they stop respecting it, the market hits harder than ever. Experienced traders blow accounts not from lack of knowledge, but from overconfidence. They start thinking their years in the market give them immunity. They forget that leverage isn't a tool, it's a weapon. And when you swing it too hard, it cuts you first. And here's something every trader needs to hear. Over-leveraging exposes your weaknesses instantly. It exposes impatience, it exposes greed, it exposes insecurity, and it exposes ego. When you use proper leverage, mistakes are small. You recover easily. But when your size is way too big, every mistake becomes a disaster. That's why blown accounts don't happen over weeks. They happen in minutes. You could be trading perfectly for months, but one oversized position is enough to erase all your progress. The solution isn't complicated, but it does require discipline. You need to choose position sizes that make sense, not sizes that make you feel like a hero. You need to trade amounts you can emotionally handle, not amounts that make you panic every time the price dips 2 points. Real pros don't go all in, they go consistent. They understand longevity beats fast money every single time. And here's the thing, you're not competing with other traders, you're competing with your own urge to gamble. If you can control that, you can stay alive in the game long enough to grow for real. If you can't, the market will expose it instantly. And speaking of exposing weaknesses, over-leveraging isn't the only greedy mistake that traders fall into. There's another trap that destroys accounts just as fast, and it usually happens right after a trader gets a little taste of profit. It's that just a little more mindset, the refusal to take profits when you should. So let's get into that next, because it's one of the biggest silent killers right behind over-leveraging. Not taking profits is one of those mistakes every trader swears they'll never make until they're deep in a trade, watching green candles climb, and suddenly the idea of closing the trade feels almost painful. You tell yourself, this thing's gonna run, I can milk a little more out of it. And that tiny, greedy thought is the exact moment the market snaps back and humbles you. It's crazy how fast your mindset shifts from smart, patient trader to someone who refuses to grab money that's literally sitting in their hand. The truth is, holding winners too long comes from a mix of greed, hope, and that dangerous belief that the market owes you something. Beginners get hit by this because they want the big win, the screenshot, the moment they feel like a trading genius. They see the trade running, and suddenly the plan goes out the window. The take-profit level they set at the start? Nah, now they're thinking way bigger. And then the market pulls back just a little, and instead of securing the profit, they tell themselves, it's just a pullback, it'll bounce. That bounce never comes, and a green trade turns into a break-even or a loss before they can even process what happened. Intermediate traders fall for this mistake in a slightly different way. They understand technicals, they know trends, they know resistance levels, but they get greedy when they see momentum. They convince themselves they're reading the chart perfectly, and instead of locking in gains, they try to nail the top of the move like some kind of market sniper. But nobody, literally nobody, catches the exact top consistently. So they hold and hold until the market reverses and they're left thinking, damn, I should have just taken the profit when it was right there. Even expert traders battle with this one. You'd think experience protects you, but honestly, the more experience you have, the more confidence you build, and sometimes that confidence makes you hold winners way past a logical point. The difference with experts, though, is they usually have risk management to survive the mistake. Beginners and intermediate traders don't, so when they refuse to take profits, the consequences hit way harder. And that's why this mistake destroys accounts, because the profit you didn't take turns into the loss you didn't expect. What makes this mistake so dangerous is how good it feels in the moment. Watching a trade run is addictive. Your brain fires dopamine like fireworks. You think, man, I'm killing it today. And that feeling makes you forget why you entered the trade in the first place. You forget your target, you forget the structure, you forget your plan. You're no longer trading the market. You're trading your emotions, and emotions don't care about logic. Another angle people don't talk about is fear. Not taking profits is actually a form of fear. Fear of missing out on more money, fear of closing too early, fear of being wrong about how far a move could go. And that fear is disguised as confidence. That's why traders don't notice it. A lot of traders say, I'll take profit on the next push, and then the next push never happens. Or they'll wait for a clean exit, whatever that means, and by the time they decide to close, the market has already reversed. The number one thing traders forget is this: the market doesn't care about how much money you want. It only gives what it wants to give, and if you don't take it when it's offered, it'll snatch it back fast. Another problem is expectations. Traders think every trade should be a home run. They set unrealistic goals like doubling their account in 1 week. When that's the mindset, taking a normal, solid profit feels too small. They feel disappointed locking in a gain because it wasn't big enough. That mindset destroys discipline, because the truth is, most successful traders build their accounts with consistent small and medium wins, not giant lucky breakouts. And here's something nobody likes to admit. Sometimes the reason you don't take profits is because you're trying to make up for earlier mistakes. Maybe you took a loss in the morning. Maybe you missed yesterday's move. Maybe your last trade was bad. So now you want this trade to fix everything. And that emotional pressure makes you hold longer than you should. You turn a good trade into a desperate one, and desperation kills accounts fast. The solution is simple but not easy. You need to treat profit-taking like a habit, not a feeling. When your plan says it's time to take profits, you take them. No questions asked. When price hits your target, you secure it, even if you think it might run more, because consistency beats perfection. And the more you train yourself to take profits without hesitation, the more disciplined and confident you become. But what really makes this mistake dangerous is how it connects to the next one. When traders don't take profits and the market reverses, guess what happens next? They don't just accept the loss, they get emotional. They get frustrated, and that frustration turns into one of the most destructive behaviors in trading. Because when you lose money you could have locked in, the urge to get it back immediately becomes almost impossible to resist. And that's where the next mistake kicks in, the one that destroys accounts even faster than not taking profits. The moment traders get upset and try to force the market to pay them back, everything spirals out of control. So let's talk about that next, revenge trading. Revenge trading is one of those mistakes that every trader thinks they're too smart to make until they actually make it. It doesn't matter if you're brand new or if you've been trading for years, when your emotions get punched in the face by a loss, your brain goes into this wild, I gotta get it back right now mode. And that feeling is so strong that even the most disciplined traders can slip. Revenge trading doesn't start with logic, it starts with pain. It starts with frustration. It starts with that one trade that didn't go the way you expected, and suddenly the market feels personal, like it's mocking you. That emotion pushes you into a state where you're no longer a trader, you're just someone trying to fight the chart. The scariest part about revenge trading is how instantly your whole mindset flips. One minute you're calm, following your plan, sticking to your rules, and the next minute you're clicking buy or sell like the market owes you an apology. You're no longer analyzing structure, you're not checking risk, you're not looking for a real setup, you're just trying to erase the loss that's eating at you. Beginners fall into this hard because they don't understand yet that losses are normal. They think every loss means something's wrong with them. So when they lose, they panic. They want redemption. They want to fix it immediately. And that rush of emotion is exactly what gets them blown out. Intermediate traders fall for revenge trading because they think they should have known better. That disappointment in themselves becomes pressure. They want to prove to themselves that they're not slipping, so they jump back in with zero patience. They end up taking a trade that wasn't part of the plan just to soothe their ego. And that's when the losses pile up one after another. It's not the first loss that hurts them. It's the 4 or 5 losses that come right after because they were trading in rage mode. Even expert traders can fall into revenge trading when they get caught off guard. You'd think experience would protect them, but revenge trading hits the ego, and even experts have egos. Sometimes it's not even a big loss that triggers it. Sometimes it's missing a perfect entry. Sometimes it's closing too early. Sometimes a trade barely hits the stop loss by a few points and then rockets in the expected direction. That's the kind of thing that pokes at your pride and pulls you into the trap. And once your pride is involved, you're not trading price action, you're trading your emotions. Revenge trading is dangerous because it makes you forget everything you know in seconds. You stop managing risk, you size up when you shouldn't, you jump into trades without confirmation, you take setups you'd normally laugh at, you start chasing the chart like the market is running away from you. Your mind becomes so focused on getting back to break even or fixing the day that you ignore every red flag. And that emotional tornado can wipe out your entire account faster than any technical mistake ever will. What makes revenge trading even worse is that it usually comes with doubling down. You think, if I lost $100, I need to make $200 back so I feel okay. So you take a bigger trade. And if that one loses, you take an even bigger one. And before you know it, you're in a full emotional spiral, stacking losses until your account looks like it's been run over by a truck. Revenge trading doesn't destroy accounts slowly. It destroys them in clusters, loss after loss after loss, because you refuse to pause for even 1 minute to clear your head. And here's the truth that most traders don't want to admit. Revenge trading comes from a lack of acceptance. If you can't accept a loss, you're going to keep fighting the market. And the market is undefeated. It doesn't care how you feel. It doesn't care that you want your money back. It doesn't care that you're mad. When you're emotional, you're the easiest target. You're trading blind, and the market punishes blind traders. The only way to defeat revenge trading is by stepping away the moment you feel that emotional pull. You have to be self-aware enough to say, yeah, I'm not thinking straight right now. I need to reset. Experts know this. They take a break after a loss. They breathe. They review. They let the emotion fade before they do anything. They don't fight the chart. They respect it. Successful traders understand that losing is part of the game. It's not personal, it's not a test, it's not a message, it's just part of trading. Accepting that truth is what keeps you from spiraling. What really makes revenge trading dangerous is how it connects to the next greedy mistake. Because once traders start fighting the market, they also start doing something even more damaging. They start adding to losing positions. They don't want to close the trade because that means accepting the loss. So they keep stacking more entries, hoping the market will turn around. And that, my friend, is where the danger really begins. Beginners fall into this trap fast because they're still learning how to deal with losses. When they see the trade moving against them, their first instinct is panic. And instead of cutting the trade and walking away, they double down. They convince themselves they're being clever, that they're averaging down, or that they've got some secret strategy. But averaging down doesn't fix mistakes, it multiplies them. That tiny initial loss suddenly grows bigger and bigger as they keep adding more money into a losing position, and before they know it, their account is taking a hit they can't recover from. Intermediate traders get hit differently. They know the rules, they know about risk management and stop losses, but adding to losing positions usually happens because of frustration or stubbornness. They've lost a trade they thought was perfect, and their ego doesn't want to admit it. So instead of accepting the loss, they add more size to the trade, telling themselves it has to turn around this time. And the market doesn't care about their ego. It'll keep moving against them, and the pain multiplies because the position is bigger and the risk is amplified. Even experienced traders aren't immune. Experts sometimes add to losing positions because they've developed a false sense of confidence in their setups. They believe that the trade is fundamentally correct and that any retracement is just temporary. So they average in, thinking they're being strategic. But the market doesn't follow beliefs, it follows price action. No matter how confident you are, stacking losing positions against the trend or without proper risk management is a recipe for disaster. It exposes even the pros to massive drawdowns if they're not careful. The real danger of adding to losing positions isn't just the financial hit, it's psychological too. Every time you throw more money into a losing trade, your stress level spikes. Your emotions start running the show. Anxiety, panic, and fear of losing your account take over. That stress clouds judgment, and suddenly you're not trading anymore. You're gambling, hoping the market finally moves your way. And gambling rarely ends well in trading. Another factor that makes this mistake deadly is how it interacts with leverage. If you're already trading with leverage and you start adding to losing positions, you're magnifying every move against you. A market move that would have been manageable with a single trade now becomes catastrophic. That's why over-leveraging and adding to losers are often part of the same account-destroying spiral. Traders start with one mistake and compound it with another, and the market wipes them out before they even realize what's happening. The key thing everyone needs to understand is this: no matter how confident you are in a trade, you can never force the market to behave your way. Trying to do so by averaging down or adding to a loser doesn't increase your chances of success, it just increases your risk exponentially. Discipline and patience are what save accounts, not stubbornly holding and stacking trades against the trend. Successful traders accept losses quickly, take the hit, and wait for the next clean setup instead of chasing the market. Now here's where it ties into the next mistake. A lot of traders who add to losing positions don't stop there. They start ignoring basic risk rules entirely. They move stop losses, they bypass exit strategies, and suddenly they're playing with fire on every single trade. That behavior leads straight into the next silent killer, ignoring your stop loss. And that's exactly what we're going to dig into next, because it's another one of those greedy habits that quietly wreck accounts while traders think they're being clever. Ignoring stop losses is one of those rookie traps that somehow even experienced traders fall into, and it's way more dangerous than most people realize. It usually starts with a simple thought: I'll just give it a little more room. It's gotta turn around. That little thought sounds harmless, even smart, right? You're just being patient. But the market doesn't care about your patience. It doesn't care that you're hoping, praying, or almost sure your trade will bounce. Ignoring a stop loss is basically telling the market, go ahead, take all my money. I trust you'll give it back eventually. And 9 times out of 10, the market doesn't play fair. Beginners fall into this trap because they're scared of losing. They place a trade, it goes against them a bit, and suddenly panic hits. They see the stop loss sitting there like a punishment waiting to happen, and they think, if I move it a little, maybe I won't get stopped out. That one little tweak turns a normal, controlled risk into a huge, unmanaged risk. They're no longer trading with discipline, they're gambling on hope. And that hope is brutal in trading. One wrong candle, one unexpected spike, and their account takes a hit they didn't plan for. Intermediate traders fall into ignoring stop losses in a slightly different way. They've got experience, they understand charts, and they've seen trends. But after a few small wins, confidence turns into overconfidence. They start thinking they can handle a trade, even if it goes against them. They start trailing stops manually, moving them further out, or sometimes they just disable them completely, thinking they know better. But the market doesn't care about how smart you think you are. When price turns sharply against you, that tiny buffer you gave yourself is gone in seconds, and now your account is bleeding because of one careless decision. Even expert traders aren't immune. They know the rules, they know the consequences, but experience can be a double-edged sword. Sometimes experts ignore stop losses because they're trying to capture a big move, or they believe the market is obviously going to reverse. Other times, it's pride. They don't want to admit they misread a setup. And when that happens, even small positions can turn into massive losses. The lesson here is brutal but simple. No level of experience protects you from the market if you ignore risk management. Ignoring stop losses is dangerous because it amplifies other mistakes. If you're over-leveraged, ignoring a stop loss is like playing Russian roulette. If you're holding multiple losing positions, ignoring a stop loss just adds fuel to the fire. And if you're emotionally compromised after revenge trading or not taking profits, ignoring a stop loss is basically inviting the market to wipe you out. Every rule you've ever learned about trading discipline gets thrown out the window when you start ignoring your safety net. The emotional side of this mistake is just as deadly. Watching a trade go against you without a stop loss feels like a slow, painful ride. Your heart rate spikes, anxiety kicks in, you start second-guessing everything. And the more you watch, the more you hope, the more you get trapped. Unlike a trade that hits a stop loss and you move on, this type of loss doesn't just hurt your account, it messes with your head. It makes you hesitant, jittery, and more likely to make emotional mistakes in future trades. The reality is, stop losses aren't arbitrary numbers. They're there to protect your account, your mental state, and your ability to trade another day. Successful traders treat stop losses like seatbelts. You don't take them off just because you're feeling lucky. You don't move them because you think the market will turn. You set them based on analysis, logic, and risk management, and you stick to them. No excuses. And here's the connection to the next trap. When traders ignore stop losses, they're already halfway into a bigger problem. Once a position runs too far against them, the temptation to act out of greed or emotion skyrockets. They start chasing moves, doubling down, and entering trades they shouldn't. That's where FOMO comes in, fear of missing out on getting their money back or catching the big move. And FOMO is another silent account killer that hits traders after they've already ignored the basic rule of risk management. So now that we've nailed why ignoring stop losses is so deadly and how it ties into emotional and greedy mistakes, the next thing we need to talk about is FOMO entries, jumping into trades at the worst possible time just because you're scared of missing out. That's the next trap that silently destroys accounts, and it's the exact behavior that sneaks in right after ignoring stop losses. FOMO entries. Man, this one's a killer. It's something almost every trader falls into at some point, whether they're fresh off the newbie block or have been grinding the charts for years. You see the market ripping a move, your friends or other traders are posting their wins, and suddenly your brain goes, yo, I gotta get in right now or I'm missing out. That panic, that fear of missing out is pure chaos disguised as opportunity. And the crazy part is, in the heat of that moment, you're not trading logically, you're reacting emotionally, like you're chasing the market instead of letting it come to you. Beginners get hit by this hard. They see a breakout, a huge green candle, a trend blasting off, and their first thought is, I need a piece of that action or I'll never catch the next one. They jump in late, sizing up too fast, and they think, it's okay, I'll hold, it'll keep running. But here's the brutal reality. Markets rarely move in straight lines. That perfect entry they imagined, they missed it, and now they're stuck chasing, often entering at the top, right before a retracement. Suddenly, what looked like a golden opportunity is a trade turning against them immediately. Intermediate traders face this trap in a different way. They know better. They've been around long enough to understand setups, support, resistance, and risk management. But even experience can't fully inoculate you against FOMO. After a loss, or even just missing a massive move, their emotional brain kicks in. I can't let that happen again. I need to catch the next one. And just like that, they skip proper analysis and jump into trades that don't meet their plan. And because they're acting out of fear instead of strategy, they're more likely to over-leverage, ignore proper stop-loss placement, or enter at the worst possible price. Even expert traders aren't immune. You'd think years of discipline would prevent FOMO, but sometimes it's subtle. Experts get impatient when a trade setup takes too long, where they see a rapid move forming in a high-probability market, and they convince themselves that missing it would be a massive regret. That impatience pushes them into entries that aren't ideal, and even with perfect risk management, a poorly timed entry increases the likelihood of getting shaken out before the real move even begins. The danger with FOMO entries isn't just the timing, it's the mindset behind it. When you're chasing a move, you're no longer trading the market. You're trading your anxiety, your ego, and your fear of being left out. That's a dangerous combo because the market doesn't care about your feelings. It moves on its own terms, and every time you try to catch it late, you're setting yourself up for a small loss at best or a blow-up at worst. What makes it worse is how FOMO ties into other mistakes. Traders who jump in late often over-leverage, ignore stop losses, or fail to take profits at logical levels. It's like a chain reaction. FOMO sparks an entry, and from there, greed and emotion take over. That's why this mistake is silent but deadly. One impulsive entry can snowball, especially if you're already recovering from previous mistakes or chasing a streak. The fix? It's all about patience and planning. High-probability setups are there every day. You don't need to chase one single candle or breakout. True pros wait for confirmations. They set alerts. They plan entries based on logic, not emotion. And they walk away if the trade isn't perfect. Missing one move is not the end of the world. The next one is always coming. But here's the kicker. FOMO doesn't just hurt your account in isolation. It leads directly into another trap that destroys accounts quietly but consistently, chasing unrealistic daily targets. When traders act out of FOMO, they start expecting every trade to be a home run, and that mindset fuels overtrading and reckless risk. And that's exactly what we're going to dive into next, because chasing numbers instead of setups is a trap even experienced traders fall into, and it's the perfect storm that keeps greedy mistakes cycling. Chasing unrealistic targets is a trap that sneaks up on traders faster than they realize, and it's one of the biggest reasons accounts get wrecked silently over time. Most traders, especially beginners, start out thinking that every trade should make a ton of money, that each setup is a ticket to doubling or tripling their account. They watch someone else post huge wins online, where they hear stories about traders flipping accounts in a week, and their brain starts telling them, yo, that could be me. That mindset isn't just dangerous, it's straight up toxic for consistent trading. The problem with setting unrealistic targets is that it warps your entire approach to the market. When your goal isn't a solid, achievable profit, but some massive number you think you deserve, your decisions start being driven by greed instead of logic. You start taking trades you wouldn't normally touch. You hold winners way too long, thinking you can hit that big number. You ignore stop losses. And even when the market gives you a nice, safe move, you don't take it because it doesn't get you close enough to your unrealistic target. In other words, you're sabotaging yourself without even realizing it. Beginners are the most obvious victims of this mistake. They want to make big gains fast because they're impatient and excited by the idea of quick success. So instead of trading for steady, achievable profits, they chase home runs on every single trade. That mindset makes them over-leverage, ignore their risk management, and take trades based on hope rather than real setups. And the reality is, the market rarely delivers home runs consistently. When the trades don't pan out, the account gets hammered, and that frustration often feeds into other greedy mistakes like revenge trading or FOMO entries. Intermediate traders get hit in a subtler way. They've had some experience, they've made money, and they've lost money, so they know the basics of risk management. But the problem comes when they set daily or weekly profit expectations that are just too high. Maybe they tell themselves, I need to make 5% today to feel good, or if I don't hit $1,000, I'm behind. That pressure messes with your decision-making. You start forcing trades, sizing up too much, or ignoring signals because you're trying to reach a number instead of trading the market. That's where consistency falls apart, and even solid setups start turning into losses because your mindset is off. Even expert traders can get caught in the unrealistic target trap. Experts often have years of experience, and they understand probabilities. But after a streak of wins, they might start thinking they're untouchable, or that the market owes them big moves. That's when they start inflating their targets, trying to push every trade further than it should go. The danger here isn't just financial, it's psychological. When you're chasing numbers instead of opportunities, your confidence starts hinging on hitting arbitrary goals instead of following your plan. And when the market inevitably doesn't cooperate, the ego hits hard, making the next mistake almost inevitable. One of the reasons this mistake is so destructive is because it compounds with other greedy behaviors we've already talked about. Unrealistic targets fuel over-leveraging, ignoring stop losses, and holding on to winners too long. They also feed FOMO entries because you start thinking, if I miss this, I'll never hit my number today. Essentially, one greedy mindset becomes the hub, spinning off multiple account-killing behaviors. And because it's all rooted in emotion rather than strategy, the cycle keeps going until your account is significantly damaged or even wiped out. The key takeaway here is that trading isn't about hitting giant numbers every day. It's about consistency, discipline, and sticking to a plan. Real pros focus on hitting realistic targets that align with their risk, their capital, and the setups they know work. They measure success not by each individual trade size, but by long-term progress. That approach keeps your emotions in check, prevents reckless behavior, and ensures your account survives the inevitable losses, which are part of the game. Now, here's the thing. Once traders start chasing unrealistic targets, they tend to overtrade. They see setups everywhere, thinking each one is the next big payday. That's where the next mistake comes in, trading every setup you see without discrimination. This overtrading habit sneaks up on both new and seasoned traders and silently chips away at accounts, even if the trades individually look good. And that's exactly what we're going to dive into next, because knowing when not to trade is just as important as knowing how to trade. Overtrading is like one of those traps that sneaks up on you when you least expect it, and it's a silent account killer that almost every trader battles at some point. It usually starts small. Maybe you missed a move, maybe a trade didn't hit your target, or maybe you're chasing unrealistic numbers like we talked about earlier. Your brain starts whispering, just one more, it'll make up for it. And that just one more thought is a slippery slope. Before you know it, you're jumping into trade after trade, ignoring the fact that your edge, your plan, and your discipline are all slipping out the window. Beginners get trapped because they're eager, impatient, and hungry for action. They see setups everywhere, and each one feels like it could be their big break. They don't understand that quality beats quantity in trading. Every extra trade taken without proper analysis adds risk, stress, and emotional baggage. Suddenly, the market feels like a casino, and their trading account becomes more about rolling the dice than following a strategy. That's how consistent gains vanish fast. The account slowly gets shredded with small mistakes stacking up because of too much activity. Intermediate traders fall into overtrading a bit differently. They've learned strategies, they know setups, and they've made profits before. But after a loss or missing a big move, they start overcompensating. They take setups that don't meet their criteria, size up too aggressively, or enter out of impatience. Overtrading in this case is usually emotionally driven. It's that desperate need to catch up or recover, and it often leads to compounding mistakes like ignoring stop losses, holding trades too long, or FOMO entries. The more trades they take without discipline, the more the odds turn against them. Even expert traders who seem untouchable aren't safe. They can overtrade too, especially after a streak of wins or during volatile markets. Experienced traders often have confidence in their analysis and skills, which sometimes makes them think every setup is worth a shot. But the market doesn't care about confidence, it only cares about price action. The danger here is that even with proper risk management, taking too many trades creates mental fatigue, reduces focus, and makes mistakes almost inevitable. Overtrading isn't just a financial problem, it's a mental problem. What makes overtrading so deadly is how it interacts with every other greedy mistake we've talked about. When you overtrade, you're more likely to overleverage, ignore stop losses, chase unrealistic targets, and make FOMO entries. Each impulsive trade chips away at your account and your confidence. Your brain starts running on autopilot, reacting to the market instead of thinking strategically. And that's when small losses add up, stress builds, and suddenly you're stuck in a cycle that's hard to break. Another sneaky factor is emotional overtrading. When traders feel frustrated, anxious, or desperate to make money, they chase trades with no edge. They take setups they wouldn't normally touch. They get impatient when the market doesn't move fast enough. And that desperation amplifies mistakes, turning what could have been a small, controlled loss into a much bigger hit. Even if one trade is harmless, stacking multiple impulsive trades makes the damage inevitable. The solution to overtrading is simple in theory, but tough in practice. You need to treat every trade like a precious opportunity, not a must-win. Stick to your setups, follow your plan, respect your risk, and don't let emotions dictate entries. Taking fewer, higher-quality trades will outperform a dozen impulsive trades every single time. Experienced traders also schedule breaks, review their decisions, and step away when the market isn't presenting clear opportunities. Mental discipline is as important as technical skill. Now here's the connection to the next mistake. Overtrading often leads to chasing trades during a losing streak, which triggers a bigger risk, the urge to risk more after losses. Once traders start taking one loss personally, the desire to get it back grows, and that's when accounts get hit the hardest. That's exactly what we'll dive into next, because understanding this behavior is crucial to stopping the spiral before it completely wipes out your account. Risking more after losses is like one of the deadliest traps in trading, and it's surprisingly common no matter your experience level. It usually starts innocently. You take a trade, it doesn't go your way, and instead of sticking to your usual risk rules, your brain whispers, "I gotta make this back fast." That little thought can snowball into disaster because it pushes you to increase your position size or take trades you normally wouldn't, all in the name of recouping losses. And that's where things start spiraling out of control. Beginners get hit hardest because losses feel personal. One losing trade can trigger a chain reaction where every subsequent trade is driven by emotion rather than strategy. They think, if I just hit one big trade, I'll fix everything. So they go bigger, they take more trades, and suddenly the account is at risk way beyond what their original plan allowed. The danger here is that the market doesn't care about your emotions. One more trade against you and the loss grows exponentially. It's the fastest way to turn a minor setback into a full-blown disaster. Intermediate traders often experience this trap a bit differently. They've been around the market, understand setups, and know proper risk management. But losses still sting, and the urge to catch up can override logic. They might increase their trade size slightly at first, thinking it's no big deal, but then the market moves against them again, and suddenly what was a small adjustment becomes a huge problem. They're not just risking money, they're risking their confidence, their discipline, and the structure that kept them alive in the first place. The pattern is clear. One loss triggers an emotional reaction, and that reaction leads to bigger risk, which leads to bigger losses. One more trade against you, and the loss grows exponentially. It's the fastest way to turn a minor setback into a full-blown disaster. Even expert traders aren't immune. Experience doesn't erase emotion. The difference is that experts often know how to hide it better, at least for a while. After a loss, they might convince themselves they can take just a little more risk because they have the skill to handle it. But markets don't reward bravado, they punish hubris. Even a small miscalculation in trade sizing after a loss can wipe out gains or push an account dangerously close to the edge. The problem isn't skill, it's letting emotion dictate risk. What makes this mistake so destructive is the compounding effect. One loss leads to bigger risk, which leads to bigger losses, which leads to even more reckless trades. It's like pouring gasoline on a fire. The initial loss might have been manageable, but when traders try to fight it by risking more, they multiply the damage. And that's why accounts get blown not from a single mistake, but from a series of emotional reactions that build on each other. The psychology behind this is brutal but simple. When you lose, your brain hates the feeling. Humans are wired to want to fix pain immediately, and that's exactly what drives this behavior. You start chasing losses instead of respecting risk. You ignore rules you normally follow. You think, I'll just make it back in one trade. And that thought alone can override months of disciplined trading. And once you start thinking that way, other greedy mistakes start creeping in. Over-leveraging, ignoring stop losses, over-trading, all the behaviors we've talked about so far. The fix is straightforward but requires discipline. After a loss, you need to reset mentally. Stick to your risk rules. Take smaller positions if needed. Step away if your emotions are too high. Accept that losses are part of the game, and that trying to immediately reverse them is one of the fastest ways to destroy your account. Professionals don't try to get it back right away. They manage risk, stay patient, and wait for the next high-probability setup. Consistency beats emotion every single time. Now, here's where this mistake sets up the final greedy trap we'll talk about. Risking more after losses, combined with greed, overconfidence, and emotional decision-making, often leads traders to treat the market like an ATM. They start believing that money is guaranteed, that they can just pull it out whenever they want, and that the market exists to pay them back. And that mindset, that's the ultimate silent account killer, and it's exactly what we'll break down next. Treating the market like an ATM is the ultimate trap, the silent killer that destroys more accounts than almost any other mistake. It usually starts small. You make a few wins, maybe a couple of big trades hit, and suddenly your brain gets this dangerous idea: the market owes me money. That feeling grows over time, especially if you've been chasing unrealistic targets, risking more after losses, or overtrading. Once you start thinking the market exists just to hand you cash, your whole approach flips from strategic trading to straight-up gambling. And that mindset, it's deadly. Beginners fall into this trap fast. They see profits coming in and start expecting it to happen every single day. That craving for instant money pushes them to take trades they wouldn't normally touch, increase risk without thinking, or ignore their usual trading rules. They're not trading charts anymore, they're trading hopes, greed, and emotions. And when the inevitable loss hits, it feels personal, like the market cheated them, which only fuels more reckless behavior. Before they know it, their account is bleeding, and the idea of trading rationally is long gone. Even intermediate traders aren't safe either. They've experienced wins and losses, so they know the mechanics of trading. But success can be a double-edged sword. A few big wins can create overconfidence, making them believe they can just pull money out whenever. That belief often leads to over-leveraging, ignoring stop losses, chasing trades, and setting unrealistic targets. In essence, they start treating trading as a money-making machine instead of a skill-based game. And the more they chase that ATM mindset, the faster losses compound. Even expert traders can fall victim, though in subtler ways. When you've been successful for a while, it's easy to expect certain moves or profits. That overconfidence makes you treat the market like a cash dispenser rather than a complex, unpredictable system. You might think, I'll just take a trade here and the money's mine, or the market owes me for my last loss. That mindset is where discipline disappears, and even seasoned traders make trades based on expectation instead of analysis. When reality hits, the consequences are usually severe because these positions are often oversized or poorly managed emotionally. The dangerous thing about treating the market like an ATM is how it amplifies every other greedy mistake we've talked about. It feeds over-leveraging because you think more money is just a swipe away. It fuels FOMO entries because you can't stand to miss out on a free move. It increases the chance of ignoring stop losses because taking a small hit feels like losing a payout you're owed. It even drives unrealistic targets and overtrading, all because you start believing profits are guaranteed instead of earned. Essentially, it transforms your mindset from strategic trading to compulsive gambling. And the psychology behind this mistake is brutal. When traders treat the market like an ATM, every loss is a personal insult, and every win is validation that they're supposed to succeed. That expectation makes them chase trades relentlessly, take risks they normally wouldn't, and act emotionally instead of rationally. And because the market doesn't owe anyone anything, reality always bites back. The more you think it's your personal money machine, the harder the punishment when trades inevitably go against you. The fix is simple, but requires a mindset shift. The market isn't a bank. It's not a machine that dispenses cash because you deserve it. Profits come from skill, discipline, and patience, not expectation or ego. Successful traders understand that losing is part of the game and that no trade is guaranteed. They approach the market with respect, treat each setup carefully, manage risk, and stay emotionally detached. They don't chase money, they chase setups. They don't expect profits, they earn them. And here's the connection to everything we've discussed. Treating the market like an ATM is the culmination of all greedy mistakes. Over-leveraging, FOMO, ignoring stop losses, revenge trading, unrealistic targets, they all feed this mindset. And once traders fall into it, they're vulnerable to almost every other mistake on this list, often simultaneously. That's why it's the silent account killer, the final trap that quietly erodes your account while you think you're winning. Up next, we're going to wrap everything together with a final message and call to action. We'll summarize all 10 greedy mistakes, show how they connect, and give you a clear roadmap to take control of your trading and protect your account. This is where it all clicks, and you get the keys to avoid these silent killers and start trading smart. Breaking the greed cycle is hands down one of the most important steps if you want to survive and thrive in trading. Because here's the harsh truth. Greed isn't just about wanting more money. It's about emotion, ego, and impulsive behavior creeping into your trading decisions. If you don't deal with it, all the skills, setups, and strategies in the world won't save your account. You can have the best chart patterns, perfect risk management, and rock-solid strategy, but if your brain is driven by greed, the market will find a way to punish you. Beginners usually don't even realize they're in the greed cycle. You start trading, you see a few wins, and suddenly every trade feels like it has to be a home run. You get obsessed with making money fast instead of making money consistently. That obsession fuels over-leveraging, revenge trading, FOMO entries, you name it. And once that cycle starts, it's like spinning in a hamster wheel. More trades, bigger risks, more losses, and the desire to fix it only pulls you deeper into the mess. The first step to breaking free is recognizing that greed is running the show. Self-awareness is the gateway to control. Intermediate traders get hit differently. They know what greed feels like, but they underestimate its power. They think, I'm disciplined, I won't let it get me. But the truth is, greed doesn't care about confidence or experience. It waits for small cracks, a missed trade, a slight loss, or even just a streak of good luck. That's when they start overtrading or pushing risk limits. The key to breaking the cycle at this stage is implementing strict rules and routines. You need clear entry and exit plans, solid risk management, and emotional checkpoints. Ask yourself, am I trading because of opportunity or because I want to hit a number? That distinction is crucial. Experts face the greed cycle in subtle ways. When you've been successful, the temptation to push limits grows. You've seen big wins, maybe even flipped accounts, and it's easy to start thinking the market owes you. That mindset is exactly what triggers the silent killers we've been talking about, treating the market like an ATM, chasing unrealistic targets, and ignoring stop losses. For pros, breaking the cycle isn't about learning new strategies, it's about realigning mindset. You need discipline checks, accountability systems, and sometimes stepping away to reset emotionally. Even one bad streak can sneak in if you get cocky. The practical steps to break the greed cycle start with discipline. First, define your risk per trade and stick to it no matter what, no exceptions. Second, set realistic targets for each session and accept that missing a move is part of trading. Third, plan trades ahead of time and follow your setups, no chasing or improvising based on emotion. And fourth, take breaks after losses or streaks of trades that didn't go as expected. Your brain needs downtime to avoid emotional burnout, which is where greed sneaks in hardest. Another key element is journaling. Keep a record of trades, not just for results, but for mindset. Note when emotions were involved, when you felt greedy, anxious, or overconfident. Seeing patterns in your own behavior is one of the fastest ways to break the cycle, because once you know when and why greed hits, you can put guards in place to stop it before it starts. Finally, focus on process over profits. Greedy traders obsess over money. Disciplined traders obsess over execution. Master the process, follow your rules, and let profits be a natural outcome, not the driving force. Celebrate sticking to your plan, taking proper risk, and executing trades correctly, even if the trade doesn't win. That mindset shift from outcome-focused to process-focused is what turns a trader from impulsive to consistent. And here's the bridge to our final section. Once you understand how to break the greed cycle, you're ready for the ultimate layer, how to maintain control and build a mindset that keeps your account safe, disciplined, and growing over time. That's where the final message comes in, tying everything together and giving you a roadmap to trade smarter, not harder. All right, let's wrap this up real talk. If you've made it this far, you now know the 10 greedy mistakes that silently destroy trading accounts, from over-leveraging and revenge trading to chasing FOMO entries and treating the market like an ATM. These aren't just random mistakes, they're patterns, habits that sneak in when emotions take over and logic steps aside. The good news? You can break them. Awareness is the first step, and discipline is the key. Stick to your rules, respect risk, manage your emotions, and focus on the process over the profits. Trading isn't about hitting home runs every day. It's about consistency, patience, and keeping your account alive so you can trade another day. Every loss isn't a failure, it's feedback. Every mistake is a lesson if you learn from it. And remember, the market doesn't owe anyone anything. Respect it, follow your setups, and keep your greed in check. If you take just one thing away from this video, let it be this. Your mindset is your biggest asset. Protect it, control it, and let it guide every trade you take. Now, if you found this video helpful and want more strategies to protect your account, dominate the charts, and trade smarter, smash that like button, hit subscribe, and drop a comment below with the greedy mistake you've struggled with the most. Don't forget to grab your free checklist in the description to keep these rules top of mind every time you trade. Stick to the process, control your emotions, and watch your trading game level up.